Hello, welcome back to Rational Investing. My name is Cameron Stewart, CFA. Thank you so much for joining me. And I really appreciate the comments that I'm getting on the channel. Thank you so much for your feedback and for your request for what stock to do. I definitely pay attention to those, and those stocks are coming, don't you worry. Also, please subscribe. If you like the content, subscribing helps me obviously get greater bandwidth out in the market, and I always appreciate that. Okay, so today I got a twist up for you. Today we're going to talk about Google and Domino's Pizza. They both IPO'd in 2004. If you have held that stock, if you put $10,000 into that IPO or any place in that year of 2004 and held the stock to this day, which one would have returned you more money? Google, right? Wrong. No. Let's dig into the data and see what happened, all right? Behind me is the return on Google and Domino's Pizza since IPO to today, roughly 15 and a half years. I've got a $10,000 investment in 2004. I'm following the stock price. Any dividends that are issued, we're reinvesting in the stock, and you can see both stocks crater in 09 or 08 with the decline. They both rebound and they both grow. Google, being the orange, is roughly 2,000% return after 15 years, or a little north of $200,000 on the principal of the $10,000 investment. Domino's is over $500,000 with a $10,000 investment, over 5,000% return. How does this happen? How did we miss this? I wasn't around in 2004. I put money into the Google IPO. What happened? Right? So there's a couple lessons here that I want to cover to figure out how can we learn from this lesson and how do we invest in the future. First lesson is the length of time. Look at this year. This is 15 years of holding a stock. Go to your portfolio. How many stocks have you held 15 years? How many stocks have you held for 2 years? Most everybody is so interested in flipping in and out based on a quarterly earnings report that they miss the big long-term perspective of holding a quality stock for over a decade, right? This is why in this channel we don't pay attention necessarily to quarterly earnings announcements or the day-to-day machinations of the market, because by and large, it's fluff, it's filler. What really matters is cash flow and long-term growth and how much the market's paying for that growth, right? This is what matters over the long-term years. I'm going to show you how to get this. All right, so Domino's continue to grow. There's a couple things that happen here. One, reinvestment of dividends. It pays a dividend, Google does not. And two, a market multiple expansion. And what does that mean? Stocks trade at multiples of earnings. We've all heard this. Multiples of EPS. Here in this channel, we use EBITDA. We use enterprise value divided by EBITDA. That is a multiple of earnings. Essentially, it's the number of years at that level of earnings it would take you to pay back your investment. Your local pizza shop on your corner, if you were to go to talk to the owner and say, hey, I want to buy you, franchisee owner, how much do you want? They will typically ask for 3 to 4 times EBITDA, right? As you get bigger, that EBITDA multiple grows. Size means a greater multiple. And when you go public, there's simply more people diving into a particular investment. That also lifts the market multiple. So multiple expansion means taking a company that's doing, say, $1 million of earnings, it's trading at 10 times earnings, it goes to 15 times earnings. The company hasn't changed, but the multiple has expanded from 10 to 15. It got a 50% up in value. That's all that means. It's how much demand is there for the stock. Think of it as the behavioral economics piece of the investment portfolio. All right. So what happened here is reinvestment of dividends and your market multiple expansion. So let's take a look at the numbers and see what happened. If I scroll over here, you'll see that over the years, this would be Domino's and Google. This is the share price average for the year. This is annualized to make it summary. Annual, the dividends they paid, shares you own, investment, and your return. And you'll notice the $10,000 investment in each case. It bought me, in Google's case, I got 200 shares. In Domino's, I get 640 shares. Okay, great. Then over time, you can see I'm just taking market price times shares, give me value. But the key difference here is the dividends. Domino's pays a dividend, Google does not. Every dividend I get, I'm buying more shares that I can buy with that dividend. And over time, my shares double. That's right, they doubled. Over the 15-year period of time, I went from owning 640 shares to just north of 1,200 shares. So without doing anything, I didn't spend the dividend, I reinvested it, my position in the stock doubled. That alone is going to boost the IRR over the years. Google did not. As you can see, you're solely dependent on Google to grow their earnings. Your share of the company didn't grow, so that you're just dependent on what they can generate for growth. Okay, that's one important lesson. The dividend is key. It allows us to get cash flow, and we can take that cash flow and we can reinvest it, in this case in Domino's, or you could take it and go invest it in another growth company, and you'd have kind of the same effect on the portfolio. But that was lesson number one, is the key for reinvestment of dividends. Now what I want to do is I want to look at what did they go public with. How can we take their public filings? In this case, I'm pulling the annual report for 2004, basically the full year after they went public. And we're going to take a look at what numbers they produced, what market multiple they traded at, and what they trade at today, and try to get some lessons learned. Over here on this side, I've got Google. On this side, I've got Domino's. Revenue. Google's revenue is $3.1 billion for the fiscal year ending the year they went public. Their S1 had 1.4 for the full year previously. Nice revenue. EBITDA for Google in the year they went public, $789 million. That's a heck of a year. Let's look at enterprise value. Debt is almost nothing. So your market cap, it's at $17.5 billion, gives you basically a $17.5 billion enterprise value. Okay? I divide the enterprise value by their earnings, by the EBITDA, and I get 22 times. That's the market multiple that Google achieved when it went public, or right thereafter, basically the fiscal year end. That's 22 times earnings. Let's take a look at Domino's and compare the two. Domino's revenue, $540 million. So less, but no slouch, still a good company. Got a little bit of growth, but really kind of quiet. If I look at EBITDA, EBITDA is $200 million. Again, a little bit of growth, but kind of weak compared to what Google was experiencing. Let's go check the Google growth. Look at the EBITDA growth of Google, right? It's tripling, 200, 400, 800. That's monstrous. People are paying a higher multiple. Let's go back to kind of the quiet, the meek, if you will. No disrespect, Domino's. $200 million. They have debt. They actually have quite a lot of debt. They went public with $781 million of debt. That is basically 4 times debt leverage, which is a levered company in our opinion. But what I want you to notice is the market multiple. So the market cap, 800 or call it 900 million, gives you an enterprise value of 1.7 billion dollars. If I divide that by the EBITDA, that's only 8 times. So I've got one stock trading at 22 times, one stock trading at 8 times. That's one of the big differences. Is when I talk about a stock that is expensive or cheap, I don't mean the stock price. I mean relative to earnings. An 8x EBITDA is cheap for a company that's growing and cash flow positive and has a decent balance sheet. It's not stellar, but has a decent balance sheet. That is a cheap company. Google at 22 times, that's very expensive for a cash flowing company. And you can see what that does over time for growth. Even though, yes, the company does grow, but you paid so much for that growth up front that it kind of caps the upside, or at least restricts the upside. I once worked for a private equity company, and they had a managing director there that I was talking to about how he invests. And he says, look, I've got a sea of analysts, and he was a big dog. He had a lot of analysts. He's like, all these guys crank out economic forecasts for me constantly. He said, but I would trade all of them in to be able to buy a company cheaply, because he knows he can make money on a company if it buys it cheap enough. Same lesson here. You've got a high multiple on Google. It's got a growth curve that's assumed that you need to hit, which is challenging. You've got a cheap company in Domino's because everybody ignored it. And what happened over time, let's check that. So now let's go forward in time, and we're going to see what happened to Google, what happened to Facebook, and how did they get such a monstrous return. All right, we've already said one thing. It was the reinvestment of dividend for Domino's. Let's check Google. So Google grew tremendously. They went from $3 billion to $161 billion of revenue. Outstanding, right? That's 2019 fiscal year. That's a monster company. Let's check EBITDA. Lo and behold, a monster EBITDA, right? 700, almost 800 million to $46 billion. Crushed it. That's ridiculous growth, right? But how come the stock is only up 2,000%? You paid a lot for it to begin with. And second, Google issued a lot of shares going down the road. So there are actually more shares outstanding now than there were when they went public. Domino's, there's about the same shares they went public as in today. Oh, let's finish the market multiple here. So where is Google today? Right, so enterprise value of Google is just shy of $1 trillion as of the end of July 19, the end of 2019. Their market multiple, right? So their market multiple is 20. Their market multiple hasn't really moved since they went public. They went public at 22. They're currently at 20. There was no market multiple expansion. In fact, it's contracted. And you get this a lot with big growth companies. I'm going to put Tesla in this category. And if you go back and watch my video, you'll see Tesla currently trades at a very high market multiple because everyone's assuming the growth. If they actually achieve it, that market multiple is going to come down and it's going to restrict your IRR in the investment. Here it's 19 times or 20 times. Let's go see what happened at Domino's. So Domino's here, revenue when they went public, 500 million, rough numbers. Now $3.6 billion. That's excellent growth over 15 years. EBITDA goes from 200 to 700 million. Good growth, not stellar, but very good. Enterprise value goes from 1.6 to 18, and debt leverage has actually moved up beyond what we would consider normal, 6 times. So it's a heavily levered company. But look at the market multiple. Right there. 8 times to 26 times. Right now, Domino's trades at a higher multiple than Google, which in of itself is an excess. I agree. This needs to come down. Domino's is overpriced. But the IRR is still there at 5,000% for the people who bought it at the IPO. And one of the reasons the return is so strong is that you bought a stock that's cheap, you reinvested the dividends all the time to double your share position, and then the market realized that Domino has growth during this pandemic. They've rushed in to buy that company. The market multiple has expanded, and you got a parabolic return. That's how it happens. That's what we look for in this channel. And that's why the fifth characteristic in the 5 characteristics that we look for is price. Price sensitivity is probably one of the biggest drivers of your economic return on investment. And you can have all the characteristics of a solid investment, but pay too much for it, and you're not going to see the return. Again, what do we look for here in this channel? There's 5 key attributes. I'll run through these really quickly. Top line revenue growth, both these have it. Earnings growth, as we define it by EBITDA, they both have it. Solid balance sheet, Google for sure. Domino's, a little sketchy. Certainly off now, I would not invest it. But at the IPO, it was fine. It was just right up north of 3. Strong cash flow. If you look into both these, they both have good cash flow. And then a well-priced stock. When you pay 8 times for a stock and you hold it for a long time, you can see what that can do. When you pay 22 times for earnings for a company, you'll see what that does. So that 5th metric for us, a well-priced stock. I mean multiple of earnings, and it's critical to be patient and wait for the market to give you a price to a stock that you can buy in at. That is why waiting for a stock and watching it sometimes for years is important, because it matters. And in the long run, if you're going to hold the stock for 15 or 20 years, give it 6 months, give it a year, wait for the price to come to you. All right. I hope you enjoyed this episode. It's a quick review of the Domino's and Google IPO and investment return. I really appreciate your time. I've got lots more videos coming up, but I want to call out that the most important thing you can do is buy a stock at a solid price, and that means cheap multiple of earnings. My name is Cameron Stewart, CFA. Thank you very much for watching Rational Investing. Take care. Bye-bye.